Welcome to another episode of Investing with IBD podcast. It's Justin Nielsen here, your host, and it is Wednesday, April 3rd, 2024, and we've got quite a show for you today. Joining me, as he always does, is Arusha Paris from O'Neill Global Advisors. He's a portfolio manager over there. How you doing, Arusha?
I'm doing well, Justin. I hope you enjoyed your vacation. It must be nice to
did.
get a vacation with this podcast plan that you have.
Well, and I heard Scott and you had a good time. So as long as he doesn't do too good a job and takes me out of my job, that's all I ask. So I hope you kind of put some speed bumps in his way or something. But hey, joining us on the show, it's a real pleasure to welcome back Mike Webster. He is the senior market strategist at Investors Business Daily, recently returned. Great to have him back. I mean, Mike and I have been working together for, we met in Philadelphia.
Are you age us?
I mean,
yes.
Mike looks really serious right now. I mean, it's like he's changed.
Yeah, so Mike and I met in Philadelphia in 1998. We were on the satellite seminar together, and this is back when you had to share rooms. You didn't get your own room when you traveled, and so Mike and I were put together, and we were chatting about stocks the entire night. It's like it was like a camp. What stocks are you buying?
It was a camp, and I remember that trip because I had just recently bought Livermore's How to Trade in Stocks, which I think is in the top 3 books of all time, and I still have that same copy. And I brought it. I planned to read it, but we were just hanging out, having a good time, and I didn't read it until after the trip.
Yeah, we did some sightseeing in Atlantic City and the Liberty Bell in Philadelphia. So yeah, it was a good time. But let's get down to business because Mike has got some stuff that he's shared with our Founders Club back in October, and it's some different ways to use the relative strength line. So we're going to get into that because one of the biggest questions people have is about holding and when to sell, and there's always that regret when, I sold too soon or whatever. So we're going to get into that. But first, let's get into the markets since you are returned as the senior market strategist for IBD. Mike, what's your take on the market right now? I mean, we just seem to have one of those rallies that has been so resilient. I mean, the 21-day moving average line has contained the bulk of this move. Distribution, hey, I don't even care. I'm still going up is what this market seems to be saying. So what's your take on the market right now?
Well, I think there's a lot of psychology going on because we had that long, bear market, and every time we'd try to poke our head up, it would reverse. So all of us kind of got programmed to, not trust the rallies. And, eventually that's when markets bottom like they did back in, October. And then we had the move up. And what was really constructive, I think, is this 3 waves down process, which was the same thing that's happened in a lot of markets. Specifically 2003, it was picture perfect where you have one pullback, you try to advance, it's not ready yet, as another one, and then finally your third one actually works. And that's a concept that Bill came up with decades ago and taught all of us, and it repeats over and over and over again. So when you have that third wave down, and then you had your nice follow through, we were off to the races, and we should have been. Like it seemed, I was almost questioning, like, God, this is too picture perfect. But yet we launched into this nice trend, and then of course it turned into a power trend, which is part of our market school rules. And maybe you can touch on that if you want to, Justin. But essentially, it's a way that you, Charles Harris, and I came up with to kind of keep you in a special market. And one of the reasons why we came up with that power trend was there were times where there was a lot of distribution and Bill didn't really seem to care. He was very dismissive of it. But there were other times where there was distribution and he was like, you got to be out 5 days of distribution. You're out the door. And he would change. And so we kind of went through history and kind of reverse engineered what we thought Bill was doing at those times. And that's where we discovered the power trend, which we've talked about on previous podcasts. So I won't get into the nitty gritty of it, but we've been in it for a long time. and it's still acting normal, it's getting a little bit tired. And it feels like we should test the 50-day. That doesn't mean we're going to, because I think everyone and their brother and their cab driver and their Uber driver is thinking we're going to test the 50-day. And so sometimes it can just grind up, kind of like it did back in, I think it was 2017, right?
Yes.
Yeah, 2017, it just was one of those where you didn't have more than a 3.4% correction in the S&P 500. So if you got shaken out of anything, it was really kind of tough to get back in a lot of cases, because there just weren't as many bases. And to your point, it was a fun project that we worked on, and of course, for the distribution days, we came up with 20 different distribution days, something like that, to kind of say, hey, they're not all created equal. And then Bill said, what did you do? Like, you're making it too complicated. Distribution is distribution. But the reality was, he didn't treat every distribution day the same, and again, there was a recognition of multiple elements. Like, okay, you've got the market doing this, you've got your individual stocks doing this. So you were kind of using all of these different inputs that told you, hey, distribution is maybe a little bit more important here, but less important here. Yeah, very interesting stuff. So,
well, actually, let me just take that a little bit further. Not the distribution day, but talk a little bit more about the 21-day moving average, because that was really, especially when we did the podcast years ago, going over the power trend, but really kind of the key thing, that the simplest thing to remember was, hey, if the Nasdaq's above the 21-day, things are still pretty good. If it's below it, maybe our stocks aren't going to trend as well. And that was easy enough for me to remember versus all the rules in market school.
You don't know all the rules of market school, Rusha.
I tried for a day, and I waved the white flag at that point. But let's go into the 21-day, because I think that for our listeners, that's a simple rule to take away, and really could just help keep them out of trouble a little bit.
Well, I'm glad you brought that up, because that's something I came up with in the late 90s. I was looking at my trading and I was just going, okay, there are times when I seem to just be connecting and everything's working, and then other times where it's not working. And I like to just reverse engineer things. And I just looked and said, okay, well, what was the market doing when I was doing well? And it tended to be trending up. And when it wasn't, when I was doing poorly, it tended to be either choppy or trending down. So I was looking for all sorts of ways to just quantify it, to have it as black and white and as simple as possible. I tested out every moving average under the sun. I tested everything I could. And I found that really the 21-day exponential, you could use simple, but I prefer exponential because it's a little bit tighter to the current trading. That when you're trending above that, that's your sweet spot. That's the time where you want to kind of push it. And when you start testing it, or you're chopping around, you're going above it, below it, above it, below it, or worse, your high is below it, that's when probably most of your trades are not going to work out. So if you guys don't remember anything from this segment at all, just remember that the 21-day is the very simplest form of just trend following. If your major average that you're following, whether it's the spiders or NASDAQ or whatever you prefer, if it's trending above a 21-day, it's kind of gas on. If you're underneath it, your brakes are on, and you're being more defensive. And then that's something I just shared with with everyone, and has kind of become its own thing. There's more of a backstory on it, but that's kind of the summary of it. Is just something I came up with. And like Bill, what he would do is, when he would discover something, instead of just keeping it to himself in-house, he would share it with everyone. And I shared it, and it puts a smile on my face when I see so many people using the 21-day, and they probably don't remember where it really came from. And that's fine with me. If it helps you stay in a trade, stay aggressive when you should be, or be more conservative when you should be, I'm happy.
Mm-hmm. And maybe talk a little bit about when you're trending above it. We kind of put something in market school where, okay, for every 5 days, what do we do? And again, this was kind of a counterbalance to distribution, when distribution is maybe saying, oh, you should sell. But if you've got this counterbalance of the 21-day, multiple days above it, What was kind of the reasoning behind your counterbalance?
Yeah. So what we had noticed was when you'd have a lot of distribution, the only way to really reset that was with either like time, like enough time went by where it was no longer relevant, or you ended up coming down enough where you had a follow through day. But there was this in between time where you're grinding higher and you've got a lot of distribution and it's not moving up enough to have it drop off. So we needed something else, something to say, okay, we had distribution, but the market doesn't care that we had distribution. So what we did is we just said, okay, every time your low has been above the 21-day for at least 5 days in a row and you close up on the day, we took that as a buy signal. And it wasn't really a natural buy signal. It was more like what you said. It was a counterbalance to what was going on with distribution. If you had a lot of distribution and the market just wasn't coming down, you wanted something else to bring your count back up, basically bring your exposure back up, because the market was just trending. And that's what we've been seeing a lot of. Now, recently here, we've tested the 21-day on the NASDAQ. So we would need 5 days with our low above that before that would trigger again. So it's not just closing above it. You really want that low above it. And maybe on a future podcast, we can talk about the Webby RSI that I developed that kind of tackles that particular problem. It's an indicator that I built.
Yeah, so
Right.
Mike, maybe actually let's take even a further step back, especially since this is your return back to the podcast after a few years. And I remember this years ago when we were working on a presentation or something, and the topic of just the overall market came up, and I said, it's like, I still place more emphasis on individual stocks to kind of help me go through. And you sat me down and said, you have to put even more emphasis on the market. You're kind of drifting back, and you give me a 30 to 45 minute lecture on why the market
was I nice?
Yeah, of course you're nice. Yeah.
You're making it sound like I lectured you like that.
No, it was great. I loved it. But
you hit my hands with a ruler, and then.
But I think maybe give a little summary of why you place so much importance on the market. Because for me personally, especially, and you saw this, after 2008, a lot of those distribution wasn't as relevant as it was before 2008. At least from my experience, it seemed like we had elevated counts and things like that. Maybe just talk a little bit about why just kind of larger market analysis is still very, very important.
Well, it's the most important part of the market. And that's something that I got from Bill. And then, I would get things from Bill, but then I would test it out myself. And all anyone has to do is just go back and look at your trading and see where you were making your money and where you were getting chopped up or losing. And you'll notice that I'm sure like 99% of the people out there will find that when the market is trending up, that's when you're making your money. Because that old saying of, the tide lifts all boats, it's just a lot easier and more forgiving when the market, opens weak like it did yesterday, but then close at the highs, because you're in a bull market. And that's what happens in a bull market. In reverse, in a bear market, you'll gap up in the morning, you'll think everything is great, want to put on trades, and then by the end of the day, you've faded. And so it really is all encompassing. The trend of the market is the most important part. And Bill thought that, I think that. Now, you don't have to use indexes for that. There's other ways of doing it, but I think the easiest way for most people is to use the index, whether it's the SPY or the NASDAQ. I use both of them. And I think just combining both of those makes it very easy to know what the health of the market is. It's kind of like the weather. If you're trending up, the sun is out. If you're trending down and you're underneath everything, it's stormy up there. And, I couldn't stand the weather when we're down low like that. That's when you don't want to trade. When it's nice and sunny, it's a bright day out, that's when you're going to want to put on your trades. So keep it simple. Just use the 21-day, use the low above it when you're trending above it. that's when you're looking for your gas pedal. You're looking to be aggressive. There's a time to be aggressive. It's a very important concept within, Bill's system, is being aggressive, but being aggressive at the right time. That means your trades are working, you're making progress, then you're going to gas it. But then if you're not, you're running into trouble, that's when you're going to back away. And it's almost always coincides with what the general market is doing.
Mm-hmm. So one part of this that, just to kind of give some pushback, especially with 2023, it was such a strong market if you looked at the indexes. And, so much of that was really, coming down to those that were the heavyweights, right? The $1 trillion market cap companies. Whereas a lot of people might have been struggling with their own decisions in stocks, because if you kind of weren't in those big guys, you weren't participating as much. On the flip side, sometimes those guys aren't participating, the big ones, and you've got these other areas like commodities that are working, or some areas that are maybe lower weights in the indexes. So does, you mentioned that sometimes you use other indicators. When you've got situations of those kinds of divergences, how do you kind of manage that?
Well, that's a good question. I think that was just a very unique time where it was kind of a product of that bear market. And each bear market has its unique aspects. Like when the bubble burst back in 2000 to 2002, almost everything fell apart, but you did have a run up in housing. And then in other bear markets, you would have other certain segments that would kind of counter trend against the market. And I think that's what was going on with this bear market, is that all the big fund managers weren't going to get in trouble for piling into, Apple and Microsoft and Meta and all the Mag 7 that we've talked about. You've got your liquidity. No one, questions you if, you're an Apple and it gets hit. But if you're in some small cap or mid cap and it gets hit, that's a, kind of a problem. And everyone's got to remember that really the market is run by just a bunch of algos and a bunch of portfolio managers, and they're trying to beat or at least stay up with what the S&P is doing. So the safest bet at that point was just going into the Mag 7 names. So yeah, the index looked great, but like you were saying, like most of the stocks, they break out and fail.
Mm-hmm.
And I think it was a unique time, and I wouldn't get too wrapped up into it. I look at the RSP, which is the equal weight of the S&P. And then that just makes Microsoft the same size as the smallest one in the S&P 500. And that kind of helps to tell you, the general breadth of the market. The other way that I do it is, as far as looking at things, I'll look at, 1,000, 1,300 stocks every day to get a sense, sometimes several times a day, to get a sense for what the market is doing, where the money is flowing into, where it's coming out of. But yeah, I wouldn't, I know a lot has been talked about with the Mag 7. I think that was a unique time and not something that we're going to see forever.
Yeah, don't change your rules based on one small sample size of an unusual situation. So when we come back, we're going to talk a little bit more about some other indicators that Mike uses for individual stocks, specifically how to hold some of the stocks that are the big winners. Stay tuned. We'll be right back. Welcome back to the Investing with IBD podcast. It's Justin Nielsen here, along with Arusha Paris from O'Neill Global Advisors. He joins me every week. And joining us this week, our special guest is Mike Webster, who has just recently returned to Investors Business Daily. So great to have him back. He, of course, is the senior market strategist here at IBD. And people have really been enjoying you on IBD Live. If you haven't checked that out, definitely make sure you do that. And we're going to get into some charts here, a little bit more chart heavy. So I just want to kind of warn folks that if you're listening to this, you might want to pop over to investors.com/podcast, like and subscribe over there with Spotify, Apple, whatever podcast you listen to, so whenever we are dropping new episodes. And it's also a good idea to kind of check out the video on some of these, especially when we get into the chart. So, Mike, before we get into your individual stock indicators that you're using for helping you hold, let's talk just one indicator that you use for the
market besides the 21-day moving average line, and that's regression channel lines. Can you describe how you use these and why you might prefer some of these over a moving average?
Yeah, I like to use them in addition to the moving averages. And let's take a look at this is the NASDAQ with my regression channel on there. And for those who are into this type of thing, I'm using a one standard deviation above and below, and I use the high plus the low divided by 2. Don't worry about all of that. This is a regression channel is just a line of best fit. It's just telling you where that trend is. And that's your white line, which is in the middle. That's your regression. That's just saying, okay, if you look between, all these dots, what is normal? What is your trend? So when I see a trend start, I put a regression on there once we get into it a few weeks, and I will stop it 50 days into it. Because if you keep on taking your regression line dates out further and further, you're looking at a bigger data set. And then that's just going to get wider and wider, and it's not really going to tell you anything.
It's going to keep on fitting to the new data, right?
By definition, right?
Yeah.
It'll be data fitting. So we're just going to take, we've got January. What were the dates that I gave you?
So November 1st, the follow through day is where you're
Yep.
starting. And then 50 days out is January 12th. So that's your second anchor point.
Yeah. So that's right here. So that's where we're stopping this. So these lines are based off the information between here and here.
And just real quickly to describe it again, you've got that dashed white line. That's your best fit line. You've got the red dashed line above. That's your one standard deviation above.
Yes.
And it's red because, be careful. You're getting up there. And then you've got the green solid line below. And that's, not to be confused with the moving average, the red line. That green solid line is your standard deviation below. And that's kind of where you want to potentially look at buying again, right?
Exactly. So there's a couple things going on when you're using regressions. One, you want to see, is the trend too steep to continue on for a long period of time? And you just look at this, if you've looked at charts for any period of time, you just know that you can't continue at that pace. But you never know how long. The old saying, the trend is your friend until the end when it bends. And it's that same thing here. And we're seeing that we're starting to fall out of it here recently. But so that's one thing you're looking for, is the angle of ascent. Is it too steep? And the other thing is, if once you get up to the top of the line, the top line, the red line, then you're getting a little too overheated, and you're expecting a pullback. If you come into the green line, if that trend is going to continue, that's an area where you're waiting for some strength to go back in and push it. So just kind of think of, the old buy high, sell low type of, or buy low, sell high type of thing within a trend is generally speaking what you're doing with this. But you also want to recognize when it starts breaking character. And let's also look at it on SPY. And here we're using the same dates that we had before, and this is for the S&P 500. And you can see how it was trending up, but then it started going at a little bit of a different angle. And you want to pay attention to when the character changes. And the character kind of changed around here. We'd gone sideways, and then we started moving forward again, kind of breaking.
So that was in January, mid-January that you're pointing to.
Exactly.
Right?
So I'm going to put a new regression channel on here.
And Mike, just quickly explain why did the character change there? It seems like explain why you were saying that the character was changing there. Just because it was starting to break out into higher highs again?
Well, what was going on? Let me just set this real quick I am using on this January 18th and then March 28th for this next 50-day period. And to me, what it looked like is you had your initial thrust from your 3 waves down, which was kind of your power from your breakout. And then it paused. You had your first initial pause of your consolidation, and it was kind of resetting itself the same way your 3 waves down, which was over in this area, 1 wave, 2 waves, 3 waves, that reset what the market was doing. So you stopped, you paused, and the market was trying to decide, are we going to roll over or are we going to move higher? And then right here, that's when it decided it was, you know what, we're going to go up again, but I'm going to remove the first one, just to clean up this chart. And you can see now with this new one that was started there, when I was saying that we had a character change, it's trading more in line with a more realistic angle. So that's telling you that this could, doesn't mean it will, could continue on longer than we think. We want to really pay a lot of attention to it when it gets down into the green area. If it gets overheated up to the red area, that's when you're saying, you know what, it's getting too hot, almost climax action type of feel from a market standpoint, that you would want to be dialing things back. You wouldn't go to cash at that, you know, if it went up to the red line, but you would just be looking for every offensive sell signal you have on your individual stocks and trying to reduce exposure. But if you get down to your green line down here and you get a turn up, that's when you're going to want to press on the gas. You don't, if it comes crashing to that line, that's different. You want it to, you want to, as Brian Shannon likes to say, you buy the strength after the dip, or he says something along those lines, which is how I've always traded too. Instead of buying the dip, I like to buy the strength after the dip, the way he does. And so it'd be the same thing. If it comes in here and then goes up, that's where you're gassing it. When you get up closer above the white line, the regression line closer to the red line, that's when you're saying, okay, things are a little bit too hot. I'm going to start dialing things back. So in a nutshell, you're using these to monitor the trend, see if, you know, it's staying within character, and it helps you to tune out the little daily noise that we have to see, like, did anything really break today, or was it really as strong of a day as we thought? And this really helps as far as I'm concerned.
Yeah. So this can really, you know, help you on the holding side, you know, for, yes, this is normal. But let's talk a little bit now about on the individual stocks.
Well, before we get into that, so Mike, just so for the SPYs, it's completely within character. For the Qs or the Nasdaq, it might be getting a little tired, or because it's starting to fall a little out of character below the lower regression line, right?
Yeah, it is starting to, certainly the original regression line, it's starting to, and let's just go ahead and add this.
Yeah, I was going to say, let's see what it looks like on your
so
your new regression.
Yep.
It's still within that. But it has gotten kind of to the top a few times, and to the bottom a few times.
Yeah, see, notice how nice that was right here. If you were using this, you would be saying, okay,
and that's in mid-February that you're talking about, for the first kind of touch of the red line.
Now, of course, this is with a bit of hindsight because it's using the data from here all the way out to March 28th. So you don't really know that at the time, but it helps you to know that, like, okay, is this regression line making sense? I'll put regression lines on all the time, and then I'll look at it and say, well, this doesn't make sense, so I'm not using it. So it's not like the 21-day I'm using all the time. The regression, I'm using it selectively when it makes sense.
When it's useful. Okay, let's get into the relative strength line, because relative strength is such an important part of what we do. We're always looking for that strength. Even that comment that you made, when you're buying on weakness, you're really buying on strength after weakness, you know, so it's something that is really ingrained into us. So if we kind of switch over to the market surge charts, you know, for that Arusha has up, let's just walk people through real quick how to use moving average lines on the relative strength. And you've got to remember that relative strength, the relative strength line is really, it's just a ratio, right? What is happening with the stock price versus the index of your choice, and we usually stick with the S&P 500. And then it doesn't really have a scale. We are usually moving it to kind of just be out of the way of the price action, so don't worry about that part. But then we're going to put a moving average line. And so, Mike, what moving average lines do you use? And maybe Arusha can kind of show where people can go on the market surge to kind of change this. So you're going to go to the settings, that wrench in the upper right hand corner. You're going to go to relative strength line, and then you have a choice. You've got two relative strength lines that you can actually use. And so we're going to set both of them to the S&P 500, but we're going to use for the daily moving average. What are you going to use here, Mike?
Yeah, so I like for the daily, I use a 21. Then for the weekly, I use an 8. And then for the monthly, I use a 10. That's for your default RS. For your RS2, which is your slower one or your longer term one, for the daily, I use a 50-day. For the weekly, I use a 21-week. And for the monthly, I use a 2-year or a 24-month. And these are all simple at this point, not exponential. And so kind of a little backstory on the moving averages. That's something I added to our to William O'Neill's institutional products maybe 20 years ago, the 2 moving averages for all sorts of reasons, but ended up kind of stumbling into how powerful it was to hold you in a stock. Let's pull up ELF because that's going to be one that we're going to talk about with this. And let's look at it on a weekly basis. You can use this on daily, weekly, and monthlies, but for this segment, we're going to go ahead and focus it on the weekly. And you can, for this segment, we can do the best fit just so we can get the whole chart in there. I typically don't use that because it squishes the scale. But what you're focusing in on is that the green line, which is your relative strength line. And like Justin was saying, it's just a ratio versus the S&P. So if you're not familiar with it, if the S&P goes up 1% and your stock goes up 1%, so it's in line with the market, that line is going to be flat for that period. But if your stock is up 2% and the market's only up 1%, then it's going to show a small increase. And of course, the reverse if it's down more. So you're looking at over time, what is that RS line doing? And using these moving averages will tell you, is it in an uptrend or not? Or is it just chopping around? And these particular values seem to work the best from the research that I've done. And like I said, I've been using variations on this for 20 years since I originally developed these moving average lines on the relative strength. And recently, over the last few years, I was looking for what can I do to solve a problem I have. Do you guys have any problems?
I got a lot of problems, Mike.
That's a whole nother podcast.
Yeah. But holding, I think that the key thing is you have a great winning stock, right?
Oh, you were talking about problems with stocks. Never mind. Okay,
Yeah,
I thought,
yeah.
Okay.
So my problem
I'm with you.
was holding, and I think it's probably a common thing. You either sell too soon or you sell too late, and so let's say you do all this work, you do all this research, you read these stories, you wait for the breakout, you buy it, yay, everything's great, and it's moving up, and for whatever reason you get dislodged from that position because you didn't have a rule to hold a core position. And so I wanted to develop something for myself, and I'm just sharing it with the world in hopes it'll help others. And so what I do is I say, okay, is once you bought the stock, and to buy it, you want it to be in a good position. And by good position, I mean the relative strength line itself is above its moving averages, where it was at that cup breakout that he's pointing to. So let's say you're buying it out of there. Once you have a gain on it to hold your core position, you're waiting for it to break these moving averages. And I've got 3 specific rules to use to kind of sell and reduce your core.
And Mike, just very quickly, when you say core position, what does that mean, or how big a position?
Okay, so everyone is going to be different. Some people like to be spread out. Some people like to be concentrated. So for sake of for this session today, we're going to just say your maximum position size is 25% in any one stock. Now, for most people, that's crazy and too concentrated, but we're just going to use that for this segment. For other people, maybe you do that all the time, but we're going to say your maximum position size is 25%, but your core is less than that. Your core is what you're going to try to hold for the big move. Let's say that's a 15% position.
Okay.
So you would have 10%, a 10% position of that, you're going to be selling into strength or selling because the market's coming in, or earnings are coming up, or for any other reason. But once you have a decent gain, you want to hold your core position for today. We're going to say it's 15%. Does that make sense?
Yep.
Yeah.
Yep. Thank you.
And it's large enough, that core position is large enough that it moves the needle on your portfolio if you get a winner. But again, it's not so large that you can't manage your risk to your portfolio if you have a normal correction. I mean, like that correction in ELF, the most recent cup, I mean, that was a 37% correction.
Yeah.
Would you want to have a 25% position and take a 37% hit in the stock? Probably not. So yeah, you're gonna want to
I couldn't withstand that. Now, towards the end of Bill's career, he wasn't doing a lot of that either. Now, early in his career, when he was younger, when he had Pick and Save and Price Company and some other stocks, he would sit through big bases.
Mm-hmm.
So it just really depends on how you're wired. And I'm not wired to want to sit through a big base like that, but I want to try to capture as much of that move up as I can. So what I developed was basically a holding rule of you're going to hold that full core position. So in this case, 15%, until you get that green line breaking one of those lines, your faster line right there. So when it breaks it, then you need to sell some. For today, we're just going to say we're going to sell it in thirds. But typically, you'd be looking at it and saying, you would look at how good the stock is, what your cost basis is, whole bunch of things, and maybe you only sell
where the market is in relation to its regression channel lines.
Yeah, all sorts of stuff, market school rules. And then you would say, okay, maybe I'm going to sell 10%, but you want to do some selling when it breaks the first time. I call that the quick, because in Bill's book, my favorite line was, there's the quick and the dead. And so I thought, okay, I'm going to use this because it always helps me to have kind of catchy things to remember, indicators by, or little stories that Bill would tell. So I said, okay, when it breaks it the first time, I'm going to be quick and get out of some. So you sell maybe 10 to a third of your core position. So you've gone from a 15% position now down to a 10. Now, if it starts going below that, so that's your first break where your relative strength line is moving through crossing your moving average. Now, if it goes below that a little bit more, it can just drip, 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 drip and get worse and worse. And so I call that the quicksand, that, you can get into this thing where it's kind of like Bill's turkey story, where if you haven't read Bill's book, get the turkey, get it out and reread the turkey story, and this will make sense to you. But anyways, you're not wanting a big gain to turn into a little gain and lose all your turkeys. So if it goes down a little bit more, which it did there, then you're going to sell. You're going to sell some more, but you're going to hold that last 5% until it breaks that blue line, which is your longer term moving average. Now, there's nothing that says that you can't buy it back. In fact, you should, but you want to wait for that green line to be back above both moving averages before you add to your stock. So let's just kind of recap this, because I know there was a lot going on. You had your cup. The moving averages were properly underneath that RS line, or the RS line was above them. You buy it, you've got a decent gain at some point. It comes down and it finally touches your moving average. So you're selling some, it goes a little bit lower. You're selling a little bit more with the quicksand, but you're waiting to sell that last 5% until it really breaks that blue line. Now it's moved up and it's giving you some chances to buy. So you might have ramped your position all the way back up to a 25% position during that. Then again, we get the quicksand, the quick and the quicksand over there. You're reducing, and then you get what I like, because I'm a deadhead, I call it the Grateful Dead break. And it's a little goofy, but it's something that I can remember. And so not there, but a little bit over to the left. When it breaks it the first time, that's when you exit the entire position. And so that allows you, that's a black and white rule that would have allowed you to to buy it at that cup and hold it all the way through and get, the heart of the watermelon, as Bill used to say. Now, then when it forms this next base, you buy it, you can buy it back, and then you're using those same exact rules to exit the position. And, you saw how it was breaking through today. So you would, in fact,
so maybe you're selling like a third today? It kind of looks like it's breaking it.
No, it's definitely breaking it. Certainly on my charts, it's breaking it. You know what? On mine, it broke both of them.
Yeah, yours
there.
Is mine delayed?
Okay, yeah, there we go.
Okay.
Oh, it updated now. Okay.
Yeah. So
now it looks right.
Yeah, that's
I was like, wait, that's
apparently I got the delayed version.
Well, it is free market access.
That's true.
That's true. Yes, free market access to market surge. So
yeah. So everyone who's listening to the podcast, I mean, you'll have another day and a half or so of free market surge access, right?
To try this
free
out.
Access, exactly.
And it's a really good idea, I think. And Mike, you suggest this all the time when you are kind of looking at a new indicator. Go back and look, okay, how would this indicator have worked with these different stocks? And you can pick any of the winners of the last year or so and say, okay, would this have kept me in? Would this have helped me or hurt me? And look at some of the stocks that you kind of wish that you had held a little bit longer. So I think it's a great time for those of you that don't have market surge to try it out right now and take advantage of that free access.
Let's speaking of that, let's take a look at VRT. And I love market surge, and I do think, especially while it's free right now, if you haven't tried it before, you haven't tried it in a while, I think you should try it out. There's so many great aspects of it that would take us hours to talk about. But with VRT, which was one of the kind of the sleepers that turned into a massive winner this year, you can see how well, if you bought it out of that cup without handle, you would be in it the whole time because it never even crossed
your whole core position.
Your full core position, because it came down to the line, but it didn't cross the line.
Yeah.
And you would have your entire position core 15%. This whole run, it's up 111%. But like what Justin said, don't go and use this indicator without testing it, whether it's my indicator or anybody else's, because you need to know the strengths and weaknesses of anything that you're using. This is not perfect. There is nothing perfect out there. So if you test it on enough stocks, you'll understand the behavior and you'll be able to look at like the ELF that we were just looking at where the data wasn't updated and going, wait a second, that should have broken. You should know what it's going to look like. And I've built a lot of things over the years, created a lot of things over the decades. And I think this is the best thing that I've done. And it's kind of sad because it's kind of the simplest.
Sometimes
simple is better.
It kind of amazes me that you've had it for 20 years. And I thought that was like kind of a new thing when you showed to me a year ago or so. Yeah,
it was like, so I put that into Wanda, which was William O'Neill's institutional thing. Really, the purpose was when Bill and I were picking names for the institutional buy list, we would try to discern what was the leader in the group. So like right now, the oils are hot. So we would go to the wrench and let's show them how they can change it to the industry group. So this was my original thought process on there. Instead of the SPY, you could put in XLE or the stocks group or, and then it's rather than comparing it to the S&P, you're comparing it to the group. Right. And that's what I thought was going to really work out. And so when I built the RS2, I also said, oh, you know what, might as well put moving averages in on there. It was kind of a throwaway thought when I was building it. And then it wasn't until I was looking at so many of these, I'm like, oh my God, it's just staring me in the face that this worked so well. And then I spent a long time testing out different moving averages. Obviously, the shorter the moving average, the faster you're going to get out, but it's going to give you a lot of false sell signals. The slower that you go, the more it's going to hold you in those wiggles and wobbles. but you're going to give a lot more off of the top. That's why I blended these two. So we've, again, just to recap, you're buying the stock when the RS line is above both moving averages. Then you're holding your core position until it breaks your shorter term moving average. When it breaks that, you're selling some of it. You're selling, let's say, a third of your core position. If the RS line moves lower than that point, you know, and it could just be a little minuscule amount lower, you're going to sell some more. And that's called the quicksand sell.
Mhm.
And then your final sell is when that RS line finally breaks that blue one, your longer term one. You say, you know what? It's time to exit. That's your Grateful Dead exit. You've got your ripple effect going on, and it's time to just put that stock aside. And if it comes back like Elf did, you can always buy it back.
Mhm.
Yeah, and Mike, so I always had trouble remembering the last one, the Grateful Dead. So to help me remind it, I just wear the T-shirt though.
Oh, well
I
done,
love you,
Arusha.
you know what?
He just opened his top a little bit like Superman, you know, like
It's so good, and it would have been so cool if I would have done the same thing. But
Yeah.
you know,
please don't.
but I do have my Grateful Dead here.
There we go.
On my
There
little
we go.
thing,
So one thing that I want to make sure that we also leave people with, and this
That's so
can
cool.
you know, this can be the last part. When do you use the weekly? When do you use the daily? And when do you use the monthly?
Okay, we'll circle back to the monthly in the last segment. So stay tuned, everyone. But
They've already left.
I'm for the daily. That let's toggle over to the daily real quick.
Yeah,
that's more for your swing trading, like what you and I are doing with the swing trader product at IBD, which I think everyone should use. That if you're swing trading a shorter term, then you're using that, and you'll notice you're going to get kicked out more frequently, but you're also not trading it for as long of a period. But still, even though it triggered a few times with your shorter term moving average, which is your 21 day, that it did hold above it for the most part. And you can blend the two. Like, it doesn't have to be all or one. You can say, you know what, I'm going to use the daily for a portion of my account, and I'm going to use the weekly for that, again, that core position that I'm trying to hold for this big move. And one last thing on this, never use this to override any other serious sell signals, like you're down on the stock. You know, this is only to be used for holding a winner. It's not to rationalize a loser. So never use it, you know, never be in a position where you're down on the stock, but, oh, it's not through Mike's, you know, Grateful Dead yet, I'm going to hold on to it. No. This is only for holding winners.
Yeah, very good point. So when we come back, we're going to go through some stocks, and you better believe we're going to be using this indicator to kind of show how you might use them. So stay tuned. We'll be right back. We're back. It's the Investing with IBD podcast, and we are here with Arusha Paris, who joins us every week, myself, Justin Nielsen, your host, and our special guest, Mike Webster, senior market strategist that has recently returned just as of last week to IBD, working with us again. So great to have him back. And we went through in the last segment using the relative strength line, and more importantly, adding some moving average lines to it to kind of really get a sense of how a stock is doing. And when it bases, hey, are you still outperforming the other members of the market or the S&P 500 itself? So let's go through a few more examples here, and we'll start with Spotify. So this is something that we just put on Swing Trader. And Mike, why don't you tell us, we'll start with the weekly chart here. So this is one that just, I mean, it really didn't even touch the 10-week moving average line. A nice move today. There was news. We didn't know that was going to happen before we put it on Swing Trader. Kind of lucked out with that news that came out. But talk a little bit about how you would use this relative strength line and the moving average lines on this one.
Yeah. So with what we're doing with Swing Trader, we wouldn't really use the weekly for it, because that was more shorter term. We'd use the daily. But for those of you who might have a position down from that cup or the little flat base that it had around 200, that's where you would use the So assuming you have a big gain in this, you would be using the weekly moving averages on here. And you see how that RS has kind of gotten close to its short-term moving average, but it didn't cross through it. So that would tell you during this little consolidation that we've had for, a few weeks now, you just hold on to it. It's still leading the, just by definition, because that RS line is above its short-term moving average. So it would have held you in here. Of course, you wouldn't have known that you were going to get some positive news today that popped it. But again, if you have a core position, you're going to wait until it breaks that to sell some. If it goes below that, you're going to sell a little bit more. And eventually, if it goes through your blue line, you'll sell out the balance of it. But let's toggle over to the daily. And I like trading stocks that I know and that I use their products. And I use Spotify. I love it. Of course, this is not a classic CanSlim name just because of the fundamentals have some issues, but it's more of, things are changing. We're not buying CDs or records anymore. Everyone's using a streaming service, and Spotify, I think, is the best one out there from a user standpoint. But it's also, you're seeing that in the stock. It's had a nice base, moved up, had another base. And we put it on Swing Trader yesterday because that was really kind of a setup day, where what I mean by a setup day is it gives you an expectation that it should move higher the next day. That doesn't mean it's going to. This time, like Justin said, we just lucked out. It got some positive news and moved up, a bunch today. But if we didn't have that news, it should have moved up at least a little bit, just because it was in that setup position. Now, if it would have just doodled around there and undercut the lows of yesterday or the day before, we would have just backed away from that position because it was a swing trade. And you really want to think of, you can turn a swing trade into a successful swing trade into a longer term hold, which is something we're going to be doing with Swing Trader, where it's kind of more of a hybrid approach. But you never want to take a kind of a losing trade and say, okay, I'm down on it. It was started off as a swing trade. Now I'm an investor and I'm going to hold this big loss. So that's the wrong way to approach it. So you can go from swing to long, but you don't want to, kind of do that in reverse. Now, RS line looks...
Mike, just very quickly, when do you do that? Or when do you decide? Is it just something you might have a little bit more conviction that you're just trading? Now, like, we're up quite a bit on it. We want to give it a little bit more room?
Oh, that's a great question. So it's a combination of things. So what I like to do is I always like to rate my stocks, and that will be both from a fundamental standpoint and a technical standpoint when I buy it. But then I'll also change that grade based on how it's trading in the market. So if I go into a stock and I say, okay, this is an A stock based off of everything that I'm looking at, just collectively the mosaic of it, putting all the little pieces together, but then it gets weaker, well, then I'm going to move that A down to a B. And then in reverse, if I started off as a B caliber stock, but you get a big move like this, because I was looking at this yesterday as like a B caliber trade because of the problems with the fundamentals. But then when you get this big move up, then it raises it up because now you've got a lot of market mechanics in there that's pushing it higher. It's telling you that you might have something special on your hands, and it's acting a lot stronger than the other stocks in your portfolio or in the market. So then you're saying, you know what, there's something special here. I'm going to hold on to it. It's kind of like what Bill did with his power from pivot rule of if it goes up a bunch out of the base in a short period of time, he used 20% within 3 weeks. That he said, you know what, I'm going to hold on to this for 8 weeks. So it's in that vein. You're looking at, really boils down to extra strength and what that RS is doing. Everything, I could turn off the chart, I could turn off the volume, I could turn everything else off, but what I couldn't turn off is that relative strength line and its moving averages. You could just use that solely to do your trading.
And, to your point earlier, this is something that you're flexible on, right? So, I mean, if it holds up here, retains the gains, it can still stay an A, but let's say it comes all the way down to the 50. Well, now it's acting a little different. Yeah, now it's enough because it broke your expectations. It's not holding. And and all of that. So for swing trader, maybe just kind of walk through a little bit. Okay, we've got some cushion now. So what do you do? You know, how do you handle this now that this has turned into an A stock, and maybe it's something that you want to hold a little bit? Do you switch to the weekly, or do you just kind of stick with the daily for now until you get a little bit more price action and history in your
Yeah,
trade?
I would. You stick with the daily when you're this early on, and this is just a luck trade, right? Just a lucky news. But lots of times it'll happen without the news, and it have a big, powerful move like this. You want to wait at least 3 weeks, if not longer, before you start toggling over to the weekly chart. If you're starting it off as a swing trade and looking at the daily, you want to make sure that you have that time element, and that goes all the way back to the Livermore book that we talked about at the beginning. It was combining the price with time, and that's something that was really underlying what Bill was doing as well, as he was always talking about building his cushion over time. So we'll be using the daily on this for this foreseeable future, at least 3-4 weeks, if this continues higher. But to answer your question, the first thing you do is you don't let a big winner turn into a loser. So from a swing trading standpoint, this is a big winner at this point. So we raise up our stop to at least break even or a little bit above that, because we don't want to let that go away. So whereas coming into today, our stop would have been at yesterday's low or the day before's low, now we've raised it up to our cost basis or a little bit higher. And sometimes it might, when you have gap ups, people like to test those lows. So it wouldn't surprise me for it to test it. I mean, it really should just keep on inching up higher, but it wouldn't be abnormal. You're always looking for normal and abnormal. It wouldn't be abnormal to test the lows of a gap up for a short period of time.
Let's go ahead and switch over to SMCI. Of course, super microcomputer has been one of those that everyone's talked about. It was something that no one had heard of, and then it has this phenomenal move, and everyone's like, well, gosh, this is amazing. This is doing something special. And of course, it based for a while and kind of went off of people's radar here at the over the summer and even into the start of this rally. Even in November 1st follow through day, this just wasn't looking like it was performing at first, but now here we go. It's moved up from 350 or so up to over 1,000. Not an easy one to hold. So how do your rules on the RS line help you with this one?
Okay, well, first I have to say I do have a position in this, but that's not why we're talking about it. Just from a compliance standpoint, I think I have to disclose it. You have one too, Justin?
No, not on this one.
Okay. So with this, if you're in it with a low cost basis, then you're going to want to use the weekly. And use the weekly RS line. So the same thing that we talked about, very simple. That green line, you're going to just hold it and wait for it to actually break that orange line there. And then you're going to sell some of your core position. If it goes below that, you're going to sell a little bit more. But if it comes all the way into that there, you've got to sell the rest. So you've got to kind of put in your mind that that's a long way down. Like, just imagine for that RS line to come all the way through that slower moving average, that would be giving up a lot of your gains. So you want to take this into the context with the rest of your portfolio and say, okay, if it starts getting weak and you're going to try to hold some of your core position for that last Grateful Dead break, then you're going to have to sell off some of your other stocks just to reduce the volatility in your account. Because this stock trades on average for the last 21 days, the average true range, which is basically just from the high to the low of the day, 10%. Wow. So most people shouldn't trade a stock that has that big of swings.
A lot of price discovery.
Yeah. Lots of price discovery. So if you've got a low cost basis, then you're using the weekly. If you have a higher cost basis, then we could toggle over to the daily in a second.
Well, and before we go over to the daily, so back like in February, we had where SMCI gapped up and eventually filled it really quickly. A lot of people were saying maybe this is a climax top. It might have been too early for that. So by using this relative strength line, you're still sticking with your full position at that point.
Okay, that's a great question. So remember,
and actually, you know what? Maybe you do go to
Should
the
I go
daily.
the daily?
For that.
Yeah,
Yeah,
maybe.
because what the
See it,
area that
yeah.
you're talking about, we got the ants indicator, right? We talked about that a few weeks ago with Scott St. Clair. But
So on
yeah,
February
and it came
16th,
down. Yeah,
right?
it came down pretty quick.
Yeah.
So yeah, go ahead, Mike.
yeah, so you're not, so let's go back to our original thought or original example that we're saying that your position size, your max was going to be 25%, but we're
Right.
only talking about using this rule for your core position. So your
Yep.
core position would be the 15%.
Yep.
So let's say you're looking at that climax action. It was not a climax top because it was too close to that
Too early,
base.
right? Yeah.
It was climax action. There is a difference, and that maybe we could talk about on a different podcast. But it's not semantics. It is important. And so that was climax action. So you could be selling offensively. In fact, you probably should be into that to reducing that. But you're trying to hold that core because you go, you know, I've got something special. It's gone up 55% within 3 weeks. If you see that little green power from pivot, saying that, you know, this is something special, just came out of a long base. I'm going to try to hold it, but you know how volatile it is. So you might have to sell stocks in your account that you don't want to, just to be able to maintain, the proper risk management, because that stock did go from 1,077 down to what's the low there 2 days later?
692.
692. Yeah.
That's
That's
lot.
a 36%.
It's a lot.
36% drop
Yeah.
in 2 days.
And
Yeah.
Mike, I do want to emphasize the other concept you're mentioning there, but I really want to just highlight it. Trying to reduce risk by reducing other positions. If you're looking at SMCI, I was like, this is doing unusual action. I might have one of the mega leaders in the market right here. I want to try to give as much room, but that being said, I want to try to reduce a little bit of risk, get rid of some maybe the lesser performing stocks.
Yeah, and look at the volatility of each stock or
Mhm.
ETF in your account, and sort them from the most volatile down to the least volatile. And so if you've got SMCI and you also have some other, I just refer to them as heat or high octane names that are really volatile, you're going to have to sell those off to protect this one. And that's what Bill was the best at, right, Justin?
Mhm.
You saw him, because Justin used to see Bill's sheets of like what he was actually doing, and he would have to sell off his other stocks to hold his baby, whatever his number one stock was. That's how he protected it. So when you're looking at a stock, it's not just about what that stock is doing. It's about what your overall account is doing, what the general market's doing, and you're having to be fluid with it. So when a stock goes from 357 up to over 1,000 in a blink of an eye, you know that there's going to be some pain involved. It is not going to just keep going up forever. So that was normal and natural, and it did not take out its 21 day. In fact, it didn't even touch its 21 day. So that was normal. Got a little bit of a gift with being added to the S&P 500. What we're noticing now is it's starting to tighten up. So the action over the last week and a half is very constructive. Will it shake out and maybe touch the 50-day? Possibly, but right now we had a nice little upside reversal. It's above the 1,000, but this is very volatile and something that most people shouldn't be trading. But we're just using it to illustrate the point that if you get into something and you have something special on your hands, let's toggle back out to the weekly for a second. That's when you can just kind of sit back and say, you know what, I'm going to study this indicator, make sure that I understand it, and then I'm going to hold my core position until these things trigger, but also kind of factor in there, how much would it have to come down for that to trigger, and how am I going to reduce my risk elsewhere?
Yeah, because as you said, a 36% correction in 2 days and it didn't trigger. So can you handle that? And I mean, it could come down more and still not triggered. So let's go ahead and move on to Nvidia. And of course, I've disclosed previously, and I still have a position in this one,
Yep.
as does Arusha. So what's your take on Nvidia? Again, for this one, it looks like we had kind of some wiggling around that moving average on the RS line for a few weeks at the end of 2023. So what's your take on this one?
Yeah, so I think this is I think everyone would agree it's probably the best stock of this bull market at this point in time. And so if you're in it and you've got a low cost basis, right now, this is where I would certainly be using the quicksand and Grateful Dead rules to hold your core position. But what was happening with that base there that you were referring to, that double bottom, and then the little flat base that happened next to it, that digestion triggered enough of those signals as far as the quick and the quicksand that you would have reduced down to just your core of your core position. So your last 5% during that time frame. And that's what you should have done. And if it looks easy now that we know that it went from 500 to almost 1,000, but during that time, it was getting a little sketchy. And what you should do is go back and do a change date and look at what the chart looked like at that time without it being, compressed this way. And yes, you should have sold, then you would have to buy back and sell and buy back some, but then you would have bought it back out of this last breakout from this last base, would have built your big position back, and it's really doing nothing wrong at this point. Could it come into the 10-week line? Would that be normal? Yeah. Of course, we know that happens all the time. Now let's go into the monthly for a second.
Well, real quick, I want to just point out because for that flattish base that you mentioned, it's important to remember, hey, that was after the follow through day, and so one of the things that was tougher about Nvidia holding it through that was you had all these other stocks that were moving so much more. And it was kind of like, well, gosh, am I, am I in the old leader? Am I in the one that's no longer working when you see everything else moving? So again, it's very important.
It's very frustrating.
Yeah. It's important to remember that context, because again, when you see, oh yeah, I went from 500 to almost 1,000, it seems easy and in hindsight when you see that. But at the time, there certainly was that context that mattered. So yeah, go ahead, Mike.
Well, that's a great point, and why you want to diversify your portfolio within different sectors. So when the chips are going through a digestion or they're just out of favor, you want to have some retail or some energy or some healthcare. So you want to be spread out both in volatile stocks as well as volatile and less volatile, because they trade differently at different times in the market. And you also want to be in different market cap size as well as you want to be in different sectors. And that'll help kind of balance things out. So if you had some stocks that were working while it was playing, as Bill would say, as playing possum.
Playing possum, right. Yep.
I got to get his accent down right. My playing possum. But Arusha, is that good?
Oh, that's so good. I don't know if it's good. Sound like Mike.
Everyone recognizes
Bill,
it as
it's just good.
That's now
everyone recognizes it as Mike's Bill impression.
Mike's Bill. So, Justin, why don't we go over to the monthly chart?
Okay, that's Arusha. He's going to go over to the monthly. Let's take a look at that.
Oh, that's right. Can you refresh that? It kind of looks a little funny on my end. Okay, so now let's say you are fortunate enough to, been in Nvidia really early on, and somehow you were able to withstand those big corrections. I don't know how you could, but I do know some people who were able to do that. That's when you're going to toggle over and say, you know what, I'm in something that I think is like Apple back, 15 years ago, or all the model book stocks that we've studied over the decades. And then you can use the monthly. Now, just remember, when you use the further out in time you go, the more off the top you're going to give back. but it will allow you to sit with those wiggles and wobbles. So if you look at that RS line versus its shorter term moving average, you've got a long way that it could fall, but that's also keeping you in that. So you would only be doing that if you have a very low cost basis. So let's say your cost basis is, under $300, then I would toggle over to kind of a combination between the weekly and the monthly, and you can do a blended approach to try to hold out for the biggest move. And I would suggest people go back and look at the biggest leaders and look at them on a monthly chart, look at them on a weekly, and then look at them on the daily. Each one has its strengths and weaknesses, and you don't have to pick just one. You can blend them and trade some of it with a daily, some of it with a weekly, some of it with a monthly.
Yeah. And it's worth remembering that, okay, for that huge move in Apple for, 15 years or whatever it was, Bill wasn't holding that through that entire time. I mean, he had a number of times where he said, I think it's done. I think this is it for Apple. But then it made another base and he was buying it back and like, oh, or they have a new product now. They've got the iPad, or they've got, they're doing this. And so, but he didn't hold through, 2008. He didn't hold through, some of those other major corrections in Apple. So
why don't you pull up Apple just I know we're way out of time, but just so people can get a sense on there, and you can look at the times where it was above it for a long time, and then it finally went below it. And I honestly don't think that there's anything better, because sure, you can use a 10-week moving average or a 50-day, but everyone else is using that too. And so you're going to get people who are kind of trading against you there. No one's really using this.
And what I like about it, Mike, is because it's always put into perspective. Like if the market is coming in, naturally all the stocks are going to come in and you're lightening up on a bunch of them, but you want to try to hold the best to last, like Bill always said, right? And so this, in many ways, at least for me personally, I have a better chance of holding it if I'm using the relative strength line versus if you're seeing the big scary price bars coming in. That's natural for any stock.
Mm-hmm.
Yeah, exactly. Do the best fit on this one just so people can get a sense if they haven't studied.
Well, there's also, when you see like these periods of flat action in the relative strength line, it kind of tells you, well, I'm taking risk. Whenever you have a single stock, there's that single stock risk. If you're not beating the S&P 500, why not just buy the S&P 500, and have that diversification?
Well, I'm glad you mentioned that, because that is really the core concept of this. Is, just thinking back to why I came up with it is our goal is to try to outperform the market, right? So you can either use like market school rules to try to, outperform the market, especially, and it really helps in downturns. But your goal is to try to beat that. So if you're going to beat that, you want to buy leading stocks. By definition, a leading stock has a leading RS, a strong RS, and that's trending up. And that's what this is a great example of. The Apple, you should go back and study it, because it'll allow you to hold it while it's rising. But you see that time frame from like 2012 to 2019, like you were saying, that entire time frame, it was just trading in line with the S&P, but you had that single stock risk. So you would have been better off with the S&P during that time frame from a risk standpoint.
Yeah. Well, hey, Mike, it's again great to have you back. I'm so excited that we're working on Swing Trader again together. Really looking forward to that and how much fun it's going to be working with you on projects. I'm sure we're going to be doing all sorts of research and sharing that on the podcast. I'm sure you're going to be coming back. In fact, we're going to have you back probably on April 17th.
How about 2 weeks, Mike?
Yeah, let's bring you back in 2 weeks if people aren't sick of you after this one.
I'm happy to be here, but every time Arusha better wear a Grateful Dead shirt.
I'm going to have to get my own just so you don't start liking Arusha more than you like me. So I'm going to try.
That could never happen.
Very good. Well, hey, thanks again, and I'm really glad you're able to share so much of what you do and the research that you put behind it. But as you mentioned, this is really important take advantage of that market surge, free access, do some playing around with your own on this indicator, look at some of the best performing stocks, see if it's something that works for you, because you got to be comfortable with an indicator before you use it. So great stuff. Thanks a lot for that, Mike.
Thanks for having me.
Okay. And then that's going to wrap it up for us this week. Don't forget, next week, we're going to be back and we have Will Clemente, who is a notable crypto evangelist that's going to be on our show. So he's going to talk to us about what's going on with crypto, the halvening that's coming up, probably pretty soon. And then also all of the ETFs that have come out and what that means for the whole supply demand. So really hope you join us for that. Thanks a lot for watching this week, and make sure you go and like and subscribe on your favorite podcast platform. You can always go to investors.com/podcast to get to your platform and like and subscribe there. So thanks a lot for watching. We'll see you next week.